owner thought the biggest problem was that the restaurant was barely surviving. The IRS thought the biggest problem was something very different. The income was understated. And that's the trap. Because a business can be losing money and still get hit for unreported income. Think about that. You're struggling, trying to keep the business alive, and at the same time, the IRS is asking, did you report all your sales? And once the IRS decides your numbers don't add up, it doesn't rely on your explanation. It starts rebuilding your income using outside records. And at that point, you're no longer telling your story, you're responding to theirs. Today's tax trap comes from a real US tax court case, and we're going to break it down step by step so you can see exactly how this kind of audit unfolds and how fast it escalates. Welcome to Ivy Smart Tax and today's tax trap.
That's uncomfortable because the owner is thinking, we're barely surviving, and the IRS is saying, that's not the issue.
Exactly. This case is about what happens when your reported sales don't match what the IRS can trace. In this case, let's call the owner Michael Carter. Michael was an attorney, but at the same time, he was also running a family restaurant. And on top of that, he owned 2 rental properties. So this wasn't a simple tax return. This was a return with multiple moving parts: a law practice, a restaurant, rental properties. And this is where many viewers should pause, because the moment your tax return includes multiple businesses, multiple income sources, multiple deduction areas, you're creating more places where things can break. Think of it like this. A simple return has fewer moving parts, so it's easier to keep everything consistent. But a complex return has more connections, more numbers that need to match, and more chances for something to go wrong.
So the more activity you have, the more opportunities for errors?
Exactly. More activity means more pressure on the entire return. And if even one area starts to get loose, it can draw attention to everything else. Now, here is the key business fact in this case. The restaurant had around 60 employees, and most customers paid by credit card. But some of the income was still cash. Michael estimated about 90% card and about 10% cash. That may sound manageable, but this is where the trap begins. Because the moment cash enters the business, the IRS starts asking, how much cash? Where did it go? Does it match the records? Cash itself is not illegal, but cash without clean records creates risk, because cash is harder to trace, and that means the IRS may look closer.
So it's not the cash itself, it's whether you can track it?
Exactly. Cash requires stronger records, not weaker ones. On the tax return, the restaurant reported about $1.6 million in sales. After expenses, it showed a loss of about $400,000. And psychologically, this is important because once an owner sees a large loss, it's easy to think there's no way the IRS will question this. But that assumption is wrong. The IRS is not asking, did you lose money? The IRS is asking, did you report all income? Those are 2 different questions. A business can lose money and still underreport income.
So a loss doesn't make the return safer?
Not at all. Losses and underreporting can exist together. Then the IRS opened the audit and found a mismatch between reported sales and what the numbers suggested. That triggered something critical: a bank deposits analysis. This is a classic IRS method. When records are unclear, the IRS may reconstruct income from external data. And this is the turning point, because once that happens, your books are no longer the only story.
So now the IRS is telling the story?
Exactly. And you're reacting to their numbers. The IRS reviewed multiple bank accounts: card deposits, cash deposits, checks, third-party payments. Some were transfers, some were not income, but many were. And this is where things get dangerous, because once the IRS separates deposits, it builds a detailed income picture. Not a guess, but a reconstruction.
So it's not just a rough estimate?
Exactly. It becomes a structured analysis. The IRS didn't stop with bank records. It also pulled third-party data, Forms 1099, 1099K, payment processors, delivery platforms, institutional clients. And here's why this matters so much. Your tax return is one version of the truth. Your bank accounts are another version. And third parties are reporting their own version directly to the IRS. And none of these depend on you. That's the trap. Because once these records start stacking up, the IRS is no longer asking, "What did you report?" It's asking, "Why don't these match?" And that's a very different question.
So even if the owner thinks the numbers are close enough, the IRS may not see it that way?
Exactly. Because third party data is treated as independent evidence. And when independent records contradict your return, it becomes much harder to rely on estimates or explanations. The IRS then combined everything: bank deposits, third party reports, and Michael's own statements, and rebuilt total gross receipts. Reported about $1.6 million. IRS reconstructed about $2.29 million. That gap is the turning point because this is no longer a bookkeeping issue. This becomes an income problem, and not a small one. At this level, the IRS is no longer thinking minor discrepancy. It's thinking significant underreporting.
So this is where the audit becomes serious?
Exactly. Because once the gap reaches this level, the IRS may increase scrutiny across the entire return. Michael pushed back. He argued some deposits were not income, but capital contributions. And this matters because not every deposit is taxable. Some deposits are legitimate transfers, loans, owner contributions. But here's the key rule: you don't just say it, you have to prove it with records, bank trails, agreements, documentation.
So this is where documentation becomes critical?
Exactly. Because once the IRS treats deposits as income, the burden shifts. And now it's your job to show why they are not. The IRS did accept some of his argument. It reduced income by about $82,000. But Michael argued there was much more. And this is where things fell apart, because he could not prove the larger amount. And this is critical. In an audit, partial proof does not fix a weak file. It only reduces part of the damage.
So even though he was partly right, it didn't change the overall result?
Exactly. Because the IRS is looking at the full picture, not just one correction. Michael also argued the business was not profitable and had financial struggles. And emotionally, that makes sense. But legally, it does not solve the income issue, because profit and income reporting are not the same thing. You can lose money and still underreport revenue.
So the IRS doesn't care how hard the business was?
Not for this question. The IRS is not asking, was it difficult? It's asking, was the income reported correctly? But the case did not stop with the restaurant. There was a second problem on the same return: depreciation. Michael claimed depreciation deductions on two rental properties. One property had a basis of about $1.8 million, the other about $700,000. Total depreciation around $57,000. But here was the issue: he did not provide enough support for the property basis or for when the properties were placed in service. And this matters because depreciation is not automatic. It must be supported with documentation, cost basis, purchase records, and placed in service dates. And this is where complex returns become dangerous, because while one issue is already under audit, another weak area can appear at the same time.
So even if the restaurant wasn't an issue, the return still had another problem?
Exactly. Multiple weak areas can stack together and make the entire return harder to defend. And then another common mistake appeared. Michael argued, "I took the same depreciation in later years. The IRS didn't say anything, so it must be fine." But that is not how tax law works. The court made it clear: just because a later year was not challenged does not mean the earlier year was correct. This is critical because many business owners think if the IRS didn't audit it, then it must be okay. But silence is not approval.
So no audit doesn't mean no problem?
Exactly. The IRS can challenge a year even if other years were not questioned. There was also another issue in this case: credibility. The taxpayers challenged procedural details, but the court rejected those arguments. And something unusual was noted: some legal references were inaccurate or unsupported. Because once credibility starts to weaken, it doesn't stay in one area. It spreads across the entire case. And now the IRS is no longer asking, is this number correct? It starts asking, can we trust anything here?
So once credibility drops, everything becomes harder to defend?
Exactly. Credibility is not a small issue. It's the foundation. So, what is the real tax trap here? It's not just cash, it's not just restaurants, it's not just depreciation. It's this combination: reported income that does not match outside records, and deductions without enough support. That combination is dangerous because once one area starts to look weak, the IRS may expand the audit into other areas, and what started as one issue becomes a full review.
So one small crack can lead the IRS to look at everything?
Exactly. Weakness invites expansion. So, what was the final result? The IRS largely won the case. The court upheld the reconstructed income and disallowed the depreciation deductions because the support was not there. And this is why this case matters. Because what the owner saw was a struggling business, messy records, and a difficult situation. But what the IRS saw was something very different: bank deposits, third party reporting, reconstructible income, and unsupported deductions. Two completely different stories. And that difference is what determines the outcome. So now ask yourself, if the IRS looked at your records today, what story would your numbers tell? Because once the IRS starts rebuilding your income, it becomes much harder to defend your position. But here's the advantage: if you can see the trap early, you can still fix it. That's exactly why this series exists. If you want more real CPA level case breakdowns like this, follow ID Smart Tax. I'll help you spot these risks early, understand how audits actually work, and avoid the mistakes that cost business owners the most.
That's the real win.
Not fixing it later, but never stepping into the trap in the first place.